is Welcome Home Radio from the Fresno Association of Realtors on 940 ESPN.
Today, we are going to be talking with a guest that's here in the studio with us, and we're going to learn about a product out there called reverse mortgages. And I have to tell you, and this is coming now from Don Scordino, who's been in the real estate business forever, reverse mortgages is one of the least understood things out there. So we have a great guy today. He's great at explaining things. Phil Risch. How you doing, Phil?
Good morning, Don. I'm doing great. Good morning, everybody.
All right. And Phil's been in the business for quite a few years. And that's, I'm not saying you're old or anything, but you have been in the business a long time, Phil. This says you were originally licensed in 1960. Now, was that a driver's license or what?
No, actually, that was my dad was in the equity business. He would buy homes that were FHA loans back in the day when it was a $35 transfer. You remember that, Don? You're that old.
Yeah. Thank you. You know, they can't see me on radio, so you don't have to be sharing that information.
All right, I'll be cautious. and my dad needed to sell those properties after he bought them, and so I actually, at age 18, went out and got licensed at the earliest age possible and started selling my dad's properties. So, yeah, I go back a few years. If you count all the numbers, it comes out to a bunch.
Okay, so you got your license at the age of 18.
I did, yeah. California. The license I hold now, it's a broker's license as well, is not that license. I could probably go back and get that number. It's probably somewhere in the 200,000 range or something.
Okay, that's like my number at Fresno MLS. Everybody laughs at it when they said, "What's your member number?" Well, I'm number 43. Well, now the new people have 15,830, and I'm number 43. Now, I'm not that old, but I think what they did is they recycled the number.
Well, you know, for the right people.
There you go. Well, okay, tell us about reverse mortgages. What in the world is a reverse mortgage?
Well, the reverse mortgage, there's many pieces to the reverse mortgage, and Don said this is going to require an explanation, but more than an explanation, really, it's going to require an education. I'm looking forward to it, by the way, because, you know, to be honest, I'm tired of not knowing about it. Well, you know, most people don't know about it, and as we get through this discussion this morning, Don, we're going to talk about the myths, the goods, the bads, and the uglies. Why do this? Do I have to be flat broke to do this? Do I need money? And there's a lot of answers to a lot of questions. But let's talk about the product itself, the actual mortgage. It's known in the industry as a HECM, H-E-C-M. And what does HECM stand for? It stands for Home Equity Conversion Mortgage. And what that means is we're going to take your home equity, and you're going to convert that to a mortgage. Why do I want to do that? I mean, I own the house free and clear. Why would I want to take and convert my home to a mortgage? Because what it will allow you to do is several things. One is to draw cash. We know of a lot of seniors, and by the way, we'll talk about qualifications and ages, a lot of seniors who are eating the box and not the actual cereal inside because they're out of cereal. They're out of money. They don't have a way to actually feed themselves. There are some real issues out there. But again, it's not only for people who need to get money, it's for people who also want to build their future and build their ability to do profit sharing, lines of credit, et cetera.
So maybe a way to look at this is everybody has in their hands their assets, whether it be their bank account, the money in their wallet, something, or their income from their jobs. It's an asset. And what we're saying here is that home equity, which is kind of the silent asset, is one of those things that you're holding in your hand that is possible to use.
That's correct. And you don't have to own the home free and clear in order to qualify. You can own your home, have a 60% equity position, 50%. And the real bonus to do, well, why would I want to do this? The real bonus is that you make no longer any mortgage payments. And that is the key. Doesn't mean you're totally irresponsible. You still have to be responsible for your state property taxes. You still have to be responsible for the homeowner's insurance. If you're in a homeowners association, such as Woodward Lake, you have to be responsible for that. However, that's it. So month after month, as the first of the month comes by, and then the 5th, and then the 15th, which is the traditional late payday, you don't have to worry about any of those, because what happens is you no longer have a mortgage payment.
So simply put, there is no mortgage payment on a reverse mortgage.
There is no mortgage payment on a reverse mortgage.
Am I correct in saying the two names are the HECM, home equity conversion mortgage, and reverse mortgage? Are they one and the same, or
it's Bob and Robert? Okay, it's the same guy. It's just two different.
Where do you come up with this stuff?
I have a brother. No, never mind. But the truth of the matter is, it is the same. A reverse mortgage, which has a name that's been known for years. By the way, the first one was done in the United States in 1981. The first reverse mortgage ever done was in England, of all places. I learned that last week at a meeting. It was a phenomenal piece of information. Not that anybody cares, but to me it was interesting.
Well, it seems fitting.
Yeah, for the British to kind of figure something like that.
Yeah.
They always go back. Excuse me, I'm sorry. Have to be cautious. The qualifications for this loan, let's get that out of the way, because if you're 45 and think, boy, this is perfect, Dad left me a house, I'll be able to move in, and that's not going to happen. The qualifications revolve around two major issues. One is age. That's the most important issue. You must be 62, and by must be, I'm talking about the youngest borrower. So if you happen to be a guy like me and you're an older fellow and you catch up with a 45-year-old gal and you wind up getting married, but you've got all this equity and you want to do a reverse mortgage, the answer is you cannot. There is not a non-borrowing spouse availability.
Okay, can that non-borrowing spouse deed off on the loan?
No, the only way that can happen, this is an interesting question because I'm in the middle of one right now where we have a person who has owned a property, her mom left it to her, she's been with a gentleman for several years, they decided to get married. Now she wants to do a reverse mortgage, she's the only one that's on the property. Can she do that? And the answer in this case is yes, because he has never, ever been on the deed. With all that, in the state of California being the community state we are, community property state, we will look at the fact that in California, you must get a waiver even though somebody has never been on the deed. You still have to get a waiver from the non-borrowing spouse. There used to be non-borrowing spouses available. You deed out, make the loan, deed back in, sort of with trust. No longer. Most lenders will not do it. There is one, but boy, you have to really, really sing a song.
Because with a typical mortgage, or when I say typical, the one that we're...
Typical or a standard or a forward is what we call it.
Okay, a forward mortgage, which is what we're all used to. It is possible even for a husband and a wife to deed off and only the one person go on title and on the loan. And I can see why in this case... it's almost a protection, too.
Well, it is a protection. That's a really good point. What happens if the borrower passes and now the non-borrowing spouse is not on the property, or she is on the property, either way, but they have no income. They have no way to pay the payment because that stops. And that's a really good segue to what happens when the mortgage ends.
Yeah, and that was one of my questions I was going to be asking you in a little bit. But it is time for our open house ads, so we need to go to that right now, Garrett. Welcome back to Welcome Home Radio. This is Don Scordino. We're here in the studio with Phil Risch of Open Mortgage. That means you're open today, right?
We're open every day.
Okay. That's probably not what you meant by the name Open Mortgage.
No, but I'll take it.
Okay, great. And we've been talking about reverse mortgages, and we were going over some of the qualifications. Can you give us the rest of those qualifications?
Yeah, really, the qualifications are very simple. They require that both borrowers be 62. The loan is basically funded as a function of the age of the youngest borrower. So again, if the 71 marries the 65-year-old person, or the 71 and 65-year-old person apply, the loan is a function of the 65-year-old, not the 71, even though he may be the head of household, etc. The reason that is because how long a person lives is a major factor to the loan itself. If somebody is going to live to 108 and they take the loan at 62, by the time they're finished, a $200,000 home may be underwater by about $450,000. The good news is that the borrower The owner of the home has no liability to that. And we'll talk about that in just a moment.
So does this mortgage give you set payments for the remainder of your life?
Yes, the set payments are zero. There are no payments until the day you either die, move out, or sell the property, at which point you must pay off the loan. You have 1 year. This is the interesting point. So here's a situation. The senior has passed. The children come in. They wind up as heirs to the property, and the property is underwater. What happens? Do these kids have to come up with these dollars? And the answer is no, they don't. This is a non-recourse loan. There is never, ever, ever recourse on this loan.
So at that point, the lender takes the hit.
Yeah, and the reason is, why does a lender do this? Why would a lender take a chance? Mm-hmm. The reason is because it's FHA insured. There is heavy insurance on this product.
That brings out a good question I have. Is FHA the only provider of this type of a reverse mortgage, or are there private money reverse mortgages?
Unlike the forward mortgage, traditional mortgage, the reverse mortgage space really is controlled by two entities. One is HUD, FHA, and they have an interesting, in each county of America, FHA has a limit, a loan limit. In Fresno, you would know what that is, Don.
281 750. Okay. 281 750. By the way, that just got lowered 2 weeks ago from 381.
But I think it's going back from everything I read.
Yeah, we're trying.
Well, everything I read says HUD may have jumped the gun. But the other side of the story is, where you have this 281 750, HUD across the country has 625.5 anywhere. So if you happen to live in Minnesota, where the average is 130, but you happen to live in a home that's 800,000, you can borrow up to 625.5 HUD. The other entity is the private money jumbo reverse. Very rare, but does occur. As an example, we have a borrower in Los Angeles, owns a property, it's worth $1.6 million, and he's doing a reverse. He owns it free and clear. He's doing a reverse for $930,000. $930,000 will never make a payment on that loan.
Okay, so does he get that $930,000 in one lump sum in the beginning, or can he set it up to get it monthly?
That's a great question, Don.
Hey, that's why I'm here, Phil.
Hopefully I'm here to answer those great questions.
We're hoping.
Up until the 30th of September this year, which we have a few days left, you could take all of that money. This borrower could take a check for $930,000 and buy a seat on the next moonshot. But on the 1st of October, things changed. What happened on the 1st of October was the federal government decided the only way to make this program really work was to cut, the amount of dollars available initially. What would happen was the senior would take that $970,000, buy the moonshot ticket, and now not be able to pay his taxes and insurance. All of a sudden, he's in trouble. He's in deep doo-doo. He's going to have to do something. So bottom line is the federal government said, here's what we're going to do. We're going to hold back 40% in the first year. You can only draw 60% of the available dollars to you in the first year.
So not 60% of the cash or equity, but 60% of the available dollars.
Yes.
What is the top loan to value?
That's a very, very difficult question to answer, and I'm not avoiding it. The reason I say that is because it's a function of really two, possibly three things. The two most important things are the age of the borrower, the age of the youngest borrower. That's the most important factor as to how many dollars, what the equity percentage will be. And the second, of course, is the amount of equity available. Is it owned free and clear? Is it owned by 30% loan, et cetera? So if there's a mortgage, we'll pay it off because you cannot have any other mortgage on this. Another qualification, by the way, which is crucial, must be your primary residence. You cannot buy this, you cannot take this mortgage and then put your home up for rent. If you do, you're allowed to do that for 1 year. The government doesn't want you to do that, but the loan says you can move out. You have a year to pay it off. But you must be, again, primary resident in order to qualify for this loan.
Oh, go ahead.
No, I was just going to say, if I could give you an exact equity, we know that 80-20 loans, 90-10, 95-5s, HUDs, et cetera, we can pick those dollars exact. We can't pick those dollars exact until we have more information on the borrower.
Okay. But, that's a fair answer, and especially dealing with HUD. I remember a few years ago when somebody said, what's the down payment requirement for an FHA loan? It was actually a 12-step formula to figure out the down payment. Now, the last few years they simplified it and just made it 3.5%. But it was ironic because I don't care how many times you did that 12-step formula, it would come out within $100 of 3%. So why couldn't they have just said 3%? Well, finally somebody listened, except they added that half. But that's HUD for you. It's not going to be simple. I do want to say this. When earlier you had said that because it's guaranteed by FHA, that's why they'll take that kind of a risk. It's guaranteed by the government. That is true, and that is why many banks will take the risk because they have that government insurance. However, I think it's important to know that FHA is a moneymaker for the federal government, and they've never needed a bailout in all these. And FHA's been around for, I think,
1935, I believe.
Yeah, you're right. Okay, so since the 30s, and we've never needed a bailout in all that time.
Well, it's interesting because when you look at the change that occurred on September 30, the 60% max, you can, if you have to, by mandatories, let's say your payoff and you have an IRS lien and so on, and that goes over 60%, they will put that over 60% payout out there. However, if you do go over 60%, the insurance premium goes from 0.5 point to 2.5. Let's say you're working with a $300,000 home, okay? Instead of having a $1,500 insurance premium, you now have, a $7,500 insurance premium. What a difference. Yeah. So, and if you want to just draw the 60 or more, you can't. It's only if you must under mandatory conditions. Mm-hmm. And those are things that are easily explainable. But it's just showing that the government recognized this as well, that they've never had a payout. And they made these changes in all reality, in my mind, and I think those that you speak to in this industry, to save the program. The program was going away because of the fact that all the money came out early. Seniors would spend that money, and foreclosures started to pop up. At that point in time, the federal government said, do we kill the program or do we fix it? And thank goodness to the seniors in this nation, they fixed it because it's the most phenomenal opportunity you'll have as a senior to protect your equity.
What were some of the big fixes?
Well, the big fixes were, one, there was a 15% haircut. That means that the actual available money to you over the entire process was cut between 10 and 15%. Again, more protection for the federal government. Okay, they have more of the equity. They have a better position so that the opportunity for foreclosure definitely decreases. Now, their position goes away as time goes on, obviously. But bottom line is the federal government saved the program with these two changes, the 15% haircut and even more than that, the 60% first-year max.
Mm-hmm. Can you explain that haircut thing again? I mean, why do they call it a haircut?
It's called it. Well, a haircut is a very common term in the mortgage industry, and in all financial corners. Actually, if you look at the stock market, they'll talk about haircuts. Haircut is basically dollars that you would have expected that now somebody else has decided to cut away, and so they call it a haircut. But basically, what it is, it's not that you lose the equity; you wind up having more equity in the property. But they are protecting themselves by this 15% and more than anything, the 60% max.
All right. You've been doing this for a while. So tell us about some of the clients that you've had and what have they used the money for? And have they taken large lump sums or have they taken installment payments to them? What do you typically see out there?
Well, the good news is they can take a combo of anything. They could take a sum, then they can leave a line of credit. They can take a lump sum, leave a line of credit, and take an annuity of so much a month. If they take an annuity for so much a month, that's for the rest of their lives. So they will wind up, if they happen to live to 106, they'll get this annuity through 106.
You say for the rest of their lives. Now there's a couple, and
rest of the surviving spouses.
So the
last borrowing spouse.
The last borrowing spouse can still take that payment in its entirety.
Its entirety, because it comes to the property owner, which is the two of them.
Gotcha.
Obviously, if he passes, it passes to her, and especially in the state of California, being a community property state. And when's the last time you wrote a joint tenancy? A tenants in common. You don't. I mean, everything is joint tenancy, right of survivorship. So the money moves, and everything continues on until the last senior passes, at which point there is 1 year time frame for the family to either sell it, refinance it, or walk away.
And, that's going to be a really good question for our next segment. What happens towards the end? And then I'd like to do a little myth busting, too, because I've heard some myths about reverse mortgages. So that will be coming up after our commercial break. But right now, stay tuned to Welcome Home Radio, 940 ESPN.
Another airplane, another sunny place. I'm a lucky and I know, but I want to go home.
You're listening to Welcome Home Radio with Don Scordino on 940 ESPN.
Welcome back to Welcome Home Radio. This is Don Scordino on a beautiful summer morning. Wait a minute, it's winter, but it looks like summer out there here in downtown Fresno. I don't know what's going on, but these temperatures are something different. But we better get a little rain here in the future.
No kidding. Oof.
All right. Anyway, we are talking about reverse mortgages. We're trying to get information on it so we understand that product. And Phil Risch has agreed to come down here and help us out with that. In fact, I understand you're teaching a class on it also in a couple of weeks at the Fresno Association of Realtors.
Yeah, that's right, Don. We're doing a class on reverse mortgage for purchase, and we'll talk about that, I assume, a little bit later.
Yeah.
But that's a phenomenal opportunity for those who are, well, we'll lay out the scenarios where it works.
Okay, let's go back to the end of a mortgage. All right, so, the 75-year-old married the 65-year-old. Of course, they did that many years ago. But,
maybe not.
Yeah. So, and then they took out this reverse mortgage. So, and there's no payments on this thing. The borrower is not making any payments on this until the youngest or the last surviving spouse passes.
Well, passes or sells.
Or
refinances.
Okay,
they're probably not going to refinance, because if they were, why would they have done the reverse mortgage anyway? So that's sort of, selling can happen, and people will sell if they're going to a home or a rest home, but generally people want to age in place. And in fact, if you want to talk about the major benefit of this product, if I had to take all the benefits, and there's a lot of them, age in place is the number one. I'm a senior myself. You probably could tell by the first license in 1960. Makes me old. Okay, so I'm one of them. Like I used to say, I'm an electrical engineer also by education. So I used to say IR1. Okay, well, IR1 is a senior, and I understand what faces you because it faces me. But the bottom line is the last surviving spouse borrower then has the choices, and if the last surviving spouse passes, the family then, the heirs will then take the choice, and the choice to the heirs are either sell it, refinance it, or let it go back to the bank.
Mm-hmm. And when it goes back to the bank, does that affect the heirs in any way?
Not in any way, shape, or form. There's no credit involved. There's no anything. There's no recourse, as we mentioned early. If for some reason the heirs decide, gosh, we love this is where we grew up, they could pay off that reverse mortgage. Mm-hmm. They could refinance it. But generally, they'll either let it go or sell it, one of the two.
And they have 1 year. Is that 1 year a hard and fast rule? Because some markets, things sell quickly, some they don't.
If it's not gone in a year, it's foreclosed.
And is that the beginning? After 1 year, do they begin the foreclosure process, or is that the end of it?
That's a great question that I don't have a solid answer to. Mm-hmm. And I'm going to guess at that because it's not crucial to. But my guess would be after the 1 year, they would start the process. Because Up until then, nobody's in default. So there's no reason to file an NOD, notice of default, if nobody's in default.
Well, your answer makes perfect common sense, but that doesn't necessarily mean that's what it is.
Never mind.
All right. But so in that 1 year, and I'm going to say in most markets, especially here in the Central Valley, that should be sufficient time to get it done.
Unless it's underwater, at which point they're going to probably walk away.
Mm-hmm.
Again, no recourse, there's no credit checks. So everybody's fine. We just move on.
All right. And I think the key thing that you said there, which kind of goes into one of the myths of this whole thing, is that the heirs, the sons, the daughters, they don't have any recourse in this.
Yeah, that's one of the great myths that we can talk about, and that's the bank owns my home. Once something happens, I pass, whatever, the bank owns the home. That is not true. If you think about this is a home equity conversion mortgage. That means it's a mortgage. In any mortgage, who holds title to the property? You do, the owner. So it's your property. It's in your name. You hold title. It's just they hold the mortgage. They have the right to foreclose. They have the right to, but they never own the property unless for some reason they do foreclose. So that is a myth.
Speaking of myths, one of the things that just kind of as a natural thing seems a little scary is that we always like to know that mortgages the balance is going down. That's your typical mortgage. And it may only be $100 a month. It might be $500 a month, but it's heading in the right direction. Whereas in this case, it's going the other way. So that's kind of a myth out there that's it's a little scary. That at some point you're going to owe more on it than what the place is worth.
Well, if that happens, consider yourself extremely lucky, because what that means is you've lived way past what the federal government figured you would.
Okay.
So actually, you're a very fortunate human being if you're way underwater on your reverse mortgage.
Okay, there's another couple of other myths that I've heard, in that it's only for broke people.
Well, that's an interesting thing. It turns out I'm working with a couple of different clients that have federal tax liens. And in their case, yes, it is only for them, for broke people. They own their properties outright, but they have these terrible tax liens, $40,000, $50,000 liens. And I understand how the IRS works. There will be, justice. They'll pay it one way or the other. Well, here's the opportunity for them to go ahead, not borrow money that they can't pay back to pay the IRS. They can't do that. Nobody's going to give them a loan. They can't do a cash-out loan because they can't pay the payments to pay it back. But they can take a reverse mortgage, and actually, in those two cases, they're under the 60%. We'll pay off the Fed lien. On the 366th day, they'll be available to get the other 40% in either a line of credit, a lump sum, whatever they wish. Okay, they can pull that. So that's one case. Another case is where I'm working with a senior who's well in his 80s, has issues with wife being hurt, needs all kinds of changes to the house. Well, what about, I don't want to go to a nursing home. I live here. I want to die here. So he wants to take this home and put all sorts of changes, etc. There's one other thing that you must understand. For a very young borrower, very young in our case is 62. That's the baby of the industry. For that borrower, and if they're in good shape and they own their home outright, they can actually put a reverse mortgage on the property, never draw a dime, and the reverse mortgage equity line of credit will grow at 1.25% above the loan rate. So if you're sitting at a 4% loan rate, your line of credit will grow at 5.25% annually. Now, what does that mean? That means that initially you were given the ability to draw, say, $200,000, but you left it all there. You didn't take any of it. Next year you can draw maybe $210,000, and the year after $230,000. And so what we're finding is that people who are taking this loan at 62, by age 72 or even 75, they have more equity than they've ever had. They have more equity than the property is worth, and that will go on forever.
So the ability to pull this equity out grows regardless of what actual equity is.
Yes.
Whoa.
Yes.
I didn't realize that.
There you go. This is a big one.
That's why I showed up today, because I wanted to learn something about, and that's a big one.
This is huge. It's huge.
So in some respects, let's say the home is now underwater, actually, but yet the ability to pull keeps going at what is it, 1.5%?
1.25% above the stated loan rate, which is whatever the rate is at the time you put the money in place. Now, you don't have to draw anything. The only thing you'll have drawn is the closing costs. An average of, let's say, $5,000 on average. You can pay for that, or you can let it sit there and pay the interest on it. But that line of credit, the balance, will grow and grow and grow. There's a great article in Forbes. There's several articles in Financial Planner magazines. Financial planners are grabbing this bad boy by left and right for their clients. That's one of my best clients as a financial planner, because they understand what this can do. Equity is no longer safe, and I don't mean that as a negative. It is what it is. Equity is no longer safe. Up until 5-6 years ago, nobody concerned themselves with equity. It just grew. But we saw it doesn't always grow. We saw it go backwards. In this loan, that wouldn't affect it. It would continue to grow at, in this case, say 5.25% line of credit.
That's interesting. So even in the dark days of 2009, 2010, the ability to pull equity out still would have grown.
Grown, exactly. Another great place for this tool is, it turns out that approximately 37% of the eligible seniors are in divorce. Can you imagine? I never knew that number was that high. This is a phenomenal tool for solving that issue. Who stays in the house? Who gets the money? Who does what? They're both seniors. They can't borrow money to pay each other off. How do they do this? Okay, so there's another way to look at how this will work.
Very interesting. Can you give us a quick rundown on the purchase part that you mentioned?
Now, this is an interesting piece. In fact, it's very new. I think the first approved purchase was 2009, so it's very new. And in fact, our company's headquartered in Austin, Texas, and on October 1 this year, they were allowed to do reverse purchases in Texas. It took that long for them to pass it through their legislature. Reverse for purchase, basically, let me set up a scenario. You're the realtor here, Don. I'm coming in from Des Moines, Iowa, sold my beautiful home, $200,000. It was like 3,800 square feet. Yeah. We're talking reality here. But my son's at Fresno State, and I'm kind of an old guy, and I'd like to be with my wife and move out here. So I come to see Don Scordino, and I have $200,000 cash, and I don't want payments. I didn't have payments. $200,000 cash, Don, buy me. So you show him $200,000 homes. And what does he do? He sticks his finger down his throat. He says, wait a minute, this is not for me. Whoa. What am I going to do here? But I don't want payments. Well, in a reverse for purchase, you can take a situation like that and increase his ability to buy. And I've done 4 examples, if it's all right with you, Don.
You got it. Go for it.
Okay. The first one is where we have a borrower who is 62 years old, he has just made eligibility. His wife just turned 62. He's 62 and a half. He would have to bring $156,600 to closing on buying a $300,000 home. So the man walked into your office with $200,000. If he spent all of his money, he'd have 2/3 the home, right? Mm-hmm. Now the other side of the coin is if he does this one, he still keeps over $40,000 in his pocket and buys a $300,000 home. Now, as we get older, if he's 67, he needs $142,800. If he's 71, he needs $135,000. And if he's a 76-year-old, he needs $126,000. So he gets to keep $75,000, buy a $300,000 house, and never make a payment. What is wrong with that picture? Can you tell me as a realtor?
Hey, I'm the guy that's supposed to be asking the questions, Phil.
I'm sorry. It dumbfounds me.
Where's our time for commercial break here?
It just dumbfounds me that people don't understand what a fabulous opportunity this is for the right circumstance.
There you go. And it does take the right circumstance, right. And that's where you need to get good counseling, because what you don't want to do in any case, is make the wrong decision in real estate. And that's where the role of the realtor, the mortgage professional comes in. And get good advice. Listen to a lot of people. And I had a great conversation with a young borrower who said, I'm being, just attacked by advice. She's, her parents were giving her advice, her cousins were giving her advice. She goes, what do I do with it? I told her, listen to every bit of it, but then with your own brain, put priorities in there and filter it out and make the best decision for you that meets your own personal decision. So that's basically the same thing with these reverse mortgages. Get a lot of advice. And I've got to tell you, it's not a simple thing. I mean, if me as a 37-year veteran, I'm still learning today from you on reverse mortgages. That tells me this was not a simple matter. So talk to a trusted mortgage professional, your realtor, get good advice on it.
Let me add something to that, if I may. One of the key factors here is education, as you said. I meet generally with a borrower 3 to 4 times before I ever bring out an application. I don't want to take an application until I know that borrower is sound for themselves, that they understand what we're doing. HUD also believes that to be an issue and requires counseling. I can't even take an application until I've made a proposal to the borrower. The borrower then calls. I can't call the counselor. The borrower must call the counselor and get counseled, generally about an hour and a half counseling session by phone or in person, stating this is what their mortgage is, this is what will happen, this is what your options are, this is. Do you understand everything going on? Because we're dealing with seniors. And bottom line is, I wish they did this more with everybody, to be quite honest. But bottom line is, they do get this counseling, and they must have it before they can even apply.
Well, that's excellent information. That kind of, you set me back to know that you actually meet with somebody 3 or 4 times before you even take an application. My hat's off to you, Phil, for doing that and taking the time, but that also shows you how important understanding what your mortgage is, how important that is.
It's interesting because I was asked by one of my borrowers, a gentleman in his mid-80s, why are you still working? And I said, I don't work. This is a passion of mine. And it is. I really am so thrilled to be able to help seniors. It's one of the great goals.
That's great. With that, we are going to our next commercial break, but stay tuned to Welcome Home Radio as we get into our forecast for 2014.
Why, I just grin like a clown. It's my kind of town.
Now back to Don Scordino and Welcome Home Radio on 940 ESPN.
And welcome back to Welcome Home Radio. This is Don Scordino, your host, and we're talking with Mr. Phil Risch of Open Mortgage, and we've been talking reverse mortgages. But you heard earlier in the show that Phil got his real estate license at the age of 18 back in, 1860?
Thanks, Don.
Oh, no, 19.
Thank you very much.
It was a while back anyway. But
yesterday.
Yeah. What was it like selling before when it was just dirt?
This was fun. Let me just give you one quick thing. I know you got when I first joined the industry, they used tear sheets. I don't know if you remember tear sheets.
No.
Tear sheets were these. Yeah, he remembers them. They used to put tear sheets in these envelopes, and on, I think it was Wednesdays and Saturdays. They would drop them off at the front of the office door. And the realtors would run in and they'd grab them and they'd take out just one and throw all the others away because they were working on a hot sale. They wanted, this is long before the book or now, of course, the internet. So that's when dirt was really the only thing you could sell.
All right. Well, you've seen a lot of things happen over the years, as I have. So let's make our forecast for 2014. Knowing that this is a radio show, hoping that nobody's writing this down and will call us next year saying, hey, you were wrong. Because, hey, it's a forecast. Everybody's crystal ball is broken. So let's see. And I want to preface it with 2013 was a huge year. It was a monumental year in real estate because things reversed. The spiral reversed. Home equity started to recover, and people are feeling better about real estate again. Whereas for a few years, it was like, oh, wow, I'm stuck with this house. Now it's, I own this house. That pride is back. And that's been really, really important in 2013. But, Phil, what would be your forecast for 2014? Where are we going to be 1 year from today?
Well, thank goodness you prefaced it with the fact that the crystal balls are broken. None of them really do work. But
well, mine does. Now, okay. I was referring to yours.
To mine, okay, yeah, because mine never has. Well, the good news about the recovery for equity, of course, is for the reverse mortgage. There's so much more equity available. But it also did something that was crucial. It told people that equity is not safe. Equity can go away unless you're involved in something that protects it. My prediction for 2014, I believe that the market will stay vibrant. I think it will slow just a little bit from where it was, and I think prices will probably cool a little bit, but will continue in the upward direction, probably somewhere in the 3 to 5% range. That's just my guess, quote unquote.
Yeah, and a cooling would not be a bad thing. I mean, I hope it doesn't go cold.
Right.
But we were red hot, white hot for 2013, especially the first part of it. And I don't know how long you can sustain something like that. So, a little cooling might be a good thing to give us some longevity in the recovery.
Maybe prevent the big bad B word, bubble.
Yeah, right. And that was, earlier in the year we talked about a double bubble. But and here's my prediction. I think we're going to continue to see things going up. I think we're going to see a recovery. I do not see a double bubble. And the biggest reason why is the first bubble happened with false loans. And that would be, when I say a false loan, I mean when you can go in, get 100% of your equity and just state your income and, on an adjustable rate mortgage and get cash out refis and bundle that all together. That was a mortgage that didn't make any sense whatsoever. And yet they were giving them out and paying the loan officers 3 times the commission to sell those as opposed to a fixed rate mortgage. So they're not doing that anymore. The people that are purchasing today they're heavily scrutinized. It's tough going through escrow. I mean, when you're finished, you're going to say, wow, we made it. But that was not easy because the underwriters are asking for everything.
And then some. They're actually doubling it up. The only place where it hasn't gotten tougher as far as qualifying is in the reverse world. Mm-hmm. And by the way, when you say that we're reversing the trend, I like that word. Thank you.
Okay. I didn't even realize I did that. Gosh. All right. I do want to give a word of caution out there because we talked a lot today about equity. Well, you go back 10 years ago and home equity was really growing, and I really think a lot of people misused their equity. In fact, in the years 2009, 2010, and 2011, for that 3-year period of time, the Fresno Association of Realtors did a survey and found that 54% of the foreclosures came from cash-out refinances. That was people using their properties as an ATM machine and probably living beyond their means and putting a credit card debt that you're paying 18% on it, but it's short-term debt and you're putting it on a 30-year mortgage. Of course, it lowered your payment, but it meant you were paying on that gasoline that you bought, on the TV that you bought, 30 years, and that didn't work. So be careful out there in using your equity. Take pride in your equity and take pride in your home. With that, I want to thank our guest, Phil Risch, for coming in today. Thank you, Phil.
Thank you so much for having me, Don.
Yeah, it's been a great show. I learned a lot. I hope our listeners learned a lot out there. And I want you to know that next week, when you tune in to Welcome Home Radio, that will be the beginning of our 6th year of doing this. And we truly appreciate our listenership. Thank you very much.